Welcome to this video on US small caps. In this video, we'll look at some of the reasons why investors may tilt their portfolio to small companies, but also the kind of macroeconomic environments in which that choice may outperform, and also the risks that come with buying small caps. Please remember that nothing in this video should be interpreted as financial advice. You should always do your own research when it comes to investing. Small cap stocks representing companies with modest market capitalizations have always intrigued investors due to their high growth potential. Unlike larger, more established companies, small caps often operate in niche sectors and with their revenue driven domestically rather than internationally. To illustrate the ranges of market capitalization, you can see 5 US equity indices here, and these decompose the US market by size. For example, whereas the S&P 500 stocks have market capitalizations of $20 billion or more, the small cap S&P 600 index has stocks with a market cap in the range $1 billion to $7 billion. Let's begin with the opportunities that small cap stocks offer at the moment. Based on data from Yardeni, and as shown in this graph, US small cap stocks are trading at a significant discount compared to large caps, with one of the largest PE ratio gaps of the last few decades as we make this video. This may make them appealing for value-focused investors. Historically, small caps have outperformed in recovery phases following recessions. They tend to bounce back strongly and offer robust returns when the economy turns around. Conversely, going into a recession, small caps tend to underperform large caps. Small caps currently represent under 3% of the S&P 1500 index, and this represents 90% of the total US stock market. That proportion of 3% is below its long-term average. Some investors may see this as a potential opportunity for increased allocation as investors seek diversification from more highly priced large caps, such as stocks in the S&P 500. However, such decisions should be aligned with personal investment goals and risk tolerance. With a trend towards reshoring and trade tariffs, small cap companies may stand to gain due to their domestic focus and ability to leverage new manufacturing opportunities within the United States. Small caps could benefit from potential Federal Reserve rate cuts, although the actual effect will also depend on broader market conditions. Their higher debt levels and floating rate liabilities make them sensitive to interest rate changes, potentially boosting profitability if interest rates fall. As you can see here, the summary of economic projections from the Federal Reserve shows that FOMC members expect rates to fall gradually over the next few years. However, this is not a forecast and will be driven by economic data as it evolves. And of course, small caps come with their own risks and challenges. While offering growth potential, small caps come with higher volatility and greater risk, often reacting more drastically to market downturns. Here you can see the rolling 3-month volatility of the small cap S&P 600 and large cap S&P 500. Notice how small caps are typically more volatile than large caps. Less analyst coverage and public information make small caps harder to evaluate. Lower liquidity can also pose challenges, affecting trade execution. Furthermore, a fund that tracks small caps tend to have higher fees, reflecting the higher cost of trading, which is passed on by the fund manager. Around 40% of Russell 2000 companies were not profitable in 2024 compared to just 6% in the S&P 500. In the face of potential recession, this could exacerbate their economic sensitivity, and it carries the risk of sharp stock price falls. So hopefully that's given you some of the potential upside, but also the risks that come with small caps. They may provide attractively valued growth opportunities, but they also come with their own risks. And as investors, we should weigh our risk tolerance and investment objectives when considering allocations to small caps. Please do like this video if you found it helpful, and remember to subscribe to Trading 212's channel so you don't miss out on future videos.